Are you worried the COVID-19 virus is going to affect the San Diego housing market? Are you worried that if we have an extended recession that your home may actually lose value? Do you need to buy or sell a home and you're worried about how you're personally going to be impacted and what your next step should be? Well, that's why I'm here. I want to talk a little bit about where the market was right before the pandemic, what's been going on over the past 2 weeks, and what to expect as we turn the page on the virus, which we will do. Hi, I'm Nick with the Iannitti Realty Group. Thanks so much for tuning in. Before we get started, I just want to give a real big thank you to all of our first responders, not just the police and firemen and doctors and nurses that are putting themselves on the front line through all this, but also all of the grocery store workers, gas station attendants, people doing deliveries, everybody who's out there putting themselves at risk, showing up to work so that the rest of us can shelter in place in a much more comfortable way. I want to give them a big shout out and say thank you so much. Also hope that you are healthy and your family and everybody's doing what they need to do, following these guidelines to stay safe. So having said that, we're going to jump right into where the market was here. If you've been watching my videos from the beginning of the year, you know that the market this year, especially in San Diego, it took off, like a rocket right out of the gate. We had a red hot real estate market, and that actually was the case all across the country. If you look at this slide here for existing home sales in the beginning of the year, we saw tremendous growth all across the country, south and northeast with double-digit growth, and San Diego was no different. Basically, still the same old story. Supply and demand. I know I kind of sound like a broken record. I've been saying this for forever on every video, but as far as our level of inventory right now in the county of San Diego for all housing types and prices, we're still sitting at only 1.7 months worth of inventory for the entire county. That number is flat. It's been that way since December, and that's definitely been spurring on what we're seeing in the market. So as far as what's been going on in the market, since we've had this quarantine issue, really things have been evolving kind of day by day, hour by hour, but I just want to give you a little bit of a window here in the last 10 days from March 20th to March 30th, according to the San Diego MLS. We had 999 new homes come onto the market in the past 10 days. We've had 744 homes go pending in escrow in the past 10 days, and we've had 1,002 homes that have sold in the past 10 days. So if you think about it, through the heart of this pandemic here, every single day on average, we have about 100 new homes come on the market, 75 of them go into escrow, and about 100 of them sell, right, which is huge. So things are still moving forward. In my own personal real estate practice over the past 2 to 3 weeks, I have been incredibly busy. I have 4 current escrows right now. 2 of my listings are getting ready to close. I had 3 buyers write offers last week, and on all 3 of those properties, the homes received multiple offers. So people are definitely still out there. Even though there is a pandemic, that does not affect the fact that people still need a place to live. Okay. Also, still, our rates are still incredibly low, the interest rates. If you notice that the 30-year mortgage rate always follows the 10-year treasury rate, at least they've kind of been in relative lockstep for about, all the way back to the beginning of the 70s. However, for the first time in a very long time, we did see a little bit of a divergence in the 2 of them being related to one another. And I think that's, again, just due to a little bit of uncertainty here in the market. But again, the moral of the story is that rates right now are incredibly low. If you are looking to buy a home, this is something you absolutely want to capitalize, right? Everybody's always asking me, I want a good deal, I want a good deal. This is the deal of the century. It's in the mortgage. You have to remember that that's the deal you're getting, especially when we're seeing rates as low as they are. It's absolutely increasing the affordability here in San Diego as it relates to the direct proportion of money you're putting out every month out of your budget to pay your mortgage, okay? When we're looking at the stock market, we've obviously seen a lot of volatility there as well, which is kind of par for the course. Whenever there's uncertainty, markets don't like that. Things go up and down. But I wanted to show you this slide here because this shows you the impact that the S&P has withstood in previous viruses going all the way back to 2003 with SARS. So what we're seeing right now is typically kind of, like I said, par for the course, although we have seen some stability in the market over the past day or so with the $2 trillion stimulus, and I'll talk about that more here in a little bit. The big thing basically right now is just getting people back to work, right? And when that's going to be able to actually happen due to the virus, okay? And what we know is that, yes, there are segments of the economy that are getting hit. Obviously, the restaurant sector is probably the largest employer here in the economy. But we also know that there's plenty of people that are still able to work. Myself, real estate was just deemed an essential business, but healthcare, pharmaceuticals, law enforcement, insurance services. There's plenty of people in high-tech jobs that have technology and are still able to actually work and contribute. Okay, PwC did a survey recently, and what they found was about 2/3 of the people thought that it would take us about a month or so to at least get the workforce reassembled after we get the all clear. 90% of those people think that it's going to take about 1 to 3 months to get everything back to business as usual, again, once we get the all clear, okay? But what I want you to realize is right now the market is being hit in a particular way, right? The segments that are being hit are really kind of discretionary spending. And it's interesting, we've seen this event kind of happen before, right? David Rosenberg, he's the chief economist with Gluskin Sheaf and Associates. He basically said that, what 9/11 has in common with what's happening right now is that the shock has also generated fear, angst, and anxiety among the general public. People avoided crowds then as they believed another terrorist attack was coming, and they're acting the same way today to avoid getting sick. We're seeing the same parts of the economy under pressure: airlines, leisure, hospitality, restaurants, entertainment, consumer discretionary services in general, okay? What I want you to realize, myself and David, we're not comparing 9/11 to COVID-19. We know that's completely different. 9/11 was a single day terrorist attack. COVID-19 is a global pandemic, and we're going to be experiencing the repercussions of it for years to come, right? It's going to take 12 to 18 months to get a vaccine, but we know even after that vaccine, people are probably still going to die from COVID-19, the same way 40,000 people here in America still die every year of the flu, despite the fact that we have a flu shot, right? But what we're talking about here is the parts of the economy that are being hit. And a lot of people are talking about, hey, all this work stoppage is probably going to lead to a recession, right? Which I would agree with, right? And what is really going to happen with home values as we see that recession basically take hold. So a lot of people are asking me now, is this the same thing as 2008? It's not. It's completely different. If you look at the slide, yes, in 2008 with the housing crash, the S&P took a correction of about 51%, and we saw home values depreciate over 10%, okay? However, when we look at like the dot-com and the 9/11 crash, we're still seeing about a 45 to 50% correction in the S&P. However, home values actually stayed stable during that time. And this is the same type of thing. We're talking about an event-based scenario here, right? Whereas in 2008, we were talking about an economically fundamental erosion. We were basically giving loans to people who should not have had them, which ultimately allowed us to kind of build this housing market in kind of a deck of cards, right? And basically that had some other ramifications once things started to get bad, right? This is not what we see in these particular types of situations. What I want you to realize too, Bill McBride came out and said, with a sudden economic stop and with many states shutting down by closing down schools, bars, and restaurants, his view is that the U.S. economy is already now in a recession. It started this month, and GDP will decline sharply in Q2 as Goldman Sachs is forecasting, and the length of the recession will depend essentially on the course of the pandemic. I think that is true. Okay, if you look at this Goldman Sachs GDP forecast, we're probably going to see a pretty big hit here come next quarter. And then once we're able to turn the page on the virus and get the all clear, we're probably going to be able to pick up the pieces rather quickly. Okay, again, it comes back to the fact that our underlying fundamentals in the economy before the pandemic were incredibly strong. Okay, so again, this event-based issue is putting a lot of downward pressure right now. And once we're able to get our heads around that and kind of turn past that, we should see some relief. We should see the economy picking back up rapidly. Okay, but the fact that we're in a recession right now, what I want you guys to realize again is the definition of a recession is simply 2 consecutive quarters where we don't have positive GDP growth. That's probably going to happen right now. Also consider too that we were in a 12-year bear market. Things have been going up, and we knew it was only a matter of time before we saw some type of correction or some type of recession. That's par for the course. We just didn't know what it was going to look like. We didn't realize it was going to be pandemic based, okay? But however, back to the slide, I've done many a video on this for the past 6 months. A recession does not equal a housing crisis, okay? It does not. A lot of people can only remember back to the last recession in 2008, and they know that they saw a lot of homes losing value in that time. That was basically brought on. It was the housing market that collapsed, and the housing market took the rest of the economy with it in that recession, okay? However, if you look at the 4 recessions prior to the last one, we actually, in 3 of them, we actually saw positive home appreciation, and that appreciation actually outstripped our 60-year moving average. Okay, so theoretically, recessions are not directly correlated with home values. That there is no correlation there. So I want you to get that kind of out of your head. Okay. Also, the Wells Fargo Investment Institute, they've come out and said, we do not expect a repeat of the severe recession of 2008-2009 because the virus and oil shocks are not endemic to the financial system, but are rather external. Once the virus infection rate peaks, we expect a recovery to gain momentum in the final quarter of the year and especially in the 2021. So again, basically they're looking at the underlying fundamentals of the economy and the fact that once we're able to put this event past us, we should be able to get back to work and ramp things back up pretty quickly, okay? The other thing though that is crucial to realize why what we're gonna have right now is not like 2008 is basically the total home equity cashed out. When you look back to 2008, right up before the crash, we had pulled out $824 billion of home equity. People were pulling all this equity out of their homes to go and buy more homes or boats and cars, all this other stuff, right? That has not happened today. Today, we only see about $232 billion of equity pulled out of the housing market, okay? What that equates to is that now 50% of all homes in the United States have more than 50% equity in them. Okay, and that's huge. In fact, 37% of all homes in the United States right now are owned free and clear without a mortgage. Okay, what that means to you is the fact that there's so many homeowners have so much equity built up in their homes right now, they're not in a position where they're just going to simply walk away from those homes like they were in 2008. That was part of the problem. In 2008, we had so many people that had no real equity in their home. When the going got tough, they simply just walked away and gave those homes back to the bank. We're not going to see that again in this particular environment because people have too much to lose. They have too much built up in their home where they're not just going to walk away and kind of do a fire sale, right? I've had lots of clients asking me, are we headed for a fire sale? Are we going to see a huge wave of foreclosures coming, okay? No, I don't think so. When you look at the steps, again, that the government is taking to kind of head this thing off at the pass, the Federal Housing Administration indicated it is enacting an immediate foreclosure and eviction moratorium for single-family homeowners with FHA-insured mortgages for the next 60 days. Furthermore, the Federal Housing Finance Agency announced it is directing Fannie Mae and Freddie Mac to suspend foreclosures and evictions for at least 60 days. What that means when it says at least 60 days is it could be longer. We could very easily see this thing go 90 days, okay? What I want you to understand, though, is if you take those FHA, Fannie Mae, and Freddie Mac mortgages and combine them, that is 90% of all the mortgages here in the United States, okay? So in other words, 90% of all mortgage holders right now are already being told by the federal government that they're not going to take action against them for at least the next 2 to 3 months as this thing starts to unfold. Okay, so I don't expect to see this wave of foreclosures because no one's going to be foreclosed on in the next 60 or 90 days. Okay, so keep that in mind as well too. It's important to keep the perspective. So anyway, that's what I wanted to share with you. If you have any questions about the concepts that I talked about, if there's any particular thing that I didn't talk about, I'm more than happy to answer your questions that you possibly have. Just reach out and let me know. And that's it. Thanks so much for tuning in. Remember, who you choose to negotiate for you absolutely matters. Now more than ever, where you're getting your housing market information also absolutely matters. So thanks so much. Stay safe out there.